Day 6 of learning equity research, how to read credit reports. Yes, today I have learned about how to read credit reports, and that's what I've shared here on the video today. So, if not people knows, I should tell them that reading credit reports really helps in your analysis, because you will remember on my very first video I mentioned that you have to investigate. You have to think of yourself as an investigator rather than just an analyst. So, when you read the credit reports, you get to investigate a lot better in the business. And not only that, even if you're thinking of just investing, when you read the credit reports, you get an idea that if you are like, is this a high risk company, is this a low risk company, you get to understand everything, and which will give you the high returns or the lower returns. Okay, so this is a very essential video for everyone who are learning equity research and also who are doing investing. But again, I want to mention before starting this video that if you want to earn rupees 30,000 to 40,000 just by working 3 hours a day, okay, just by working 3 hours a day, then WhatsApp me on this number right here. Then I'll share you the whole details, the whole process, so you can start and work with us so that you get to earn rupees 30,000 to 40,000. So WhatsApp me right now and let's start today's video. Day 6 of learning equity research, how to read credit reports, the most important yet ignored report. Smart analysts don't ignore credit reports. A credit report is one of the most crucial yet overlooked tools in equity research. The intelligent analyst knows that understanding a company's creditworthiness provides deep insights into its financial strength, risk profile, and overall stability. Let's break it down step by step. What is a credit report? Whenever a company borrows money, whether from a bank or the public markets, it is required by law to obtain a rating from an independent credit rating agency. These agencies analyze financial statements to determine credit strength, how strong is the company's financial health, business profile, what does the company do and how stable is its industry, financial profile, are the revenues and profits stable, interest payment capacity, how well can the company cover its interest payments. This is often measured as the interest coverage ratio, that is, how many times a company can pay its interest obligation. Based on this analysis, agencies assign a credit rating which helps investors assess a company's financial soundness and risk. Where to find credit reports? Go to screener.com, search for the stock you want to analyze, navigate to the documents section, and select Rating Update under Credit Ratings. You'll be redirected to ratings such as Crystal Ratings, which provides the complete credit report. What are credit ratings? Credit ratings are symbolic representations of a company's ability to repay debt. Think of them as school grades. AAA, top of the class, extremely stable and low risk. AA, excellent but slightly riskier than AAA. A, good but not as strong. Triple B, average, still investment grade but with some risk. Below triple B, junk status, higher risk of default, much like a failing student who is in danger of being expelled. For example, ITC Limited has a AAA rating, meaning it's one of the most financially secure companies. Adani Enterprises has an A plus rating, indicating stability but with more associated risks. Varun Beverages has a AA plus rating, showing strong creditworthiness but slightly below AAA. Why credit ratings matter in equity research? First and foremost, valuation and cost of debt. When valuing a company, analysts need to determine the discount rate used to calculate the present value of future cash flows. One component of this is the cost of debt, which can be derived from credit ratings. A higher credit rating means lower borrowing costs and vice versa. Number two, understanding business strength. Credit reports explain the rationale behind the rating. Example, if ITC has a AAA rating, the report will break down why. Example, strong FMCG business, dominant market share in cigarettes, solid financials, etc. Reading these reports teaches you how credit rating agencies assess businesses and industries, a critical skill for analysts. Number three, business insights and competitive advantage. Credit rating reports don't just rate companies, they provide deep insights into entire industries. Example, Crystal's rating criteria for FMCG companies focus on market position, product mix, branding, pricing power, and distribution network. If a company is rated highly, it means it excels in these factors. Breaking down a credit report, example ITC. Market position. ITC dominates the cigarette industry, almost a monopoly in India. It has a growing presence in FMCG, competing with HUL and Nestle. Product mix. ITC isn't just about cigarettes, it has FMCG foods, personal care, hotels, packaging, and agribusiness. Credit reports detail how much revenue each segment contributes. Innovation track record. Does the company regularly launch new products? ITC has expanded into biscuits, noodles, and dairy. This is an essential factor in assessing long term sustainability. Differentiation and branding. Brand power matters. People choose Britannia biscuits over an unknown brand. A strong brand means higher pricing power and consumer loyalty. Financial strength and debt profile. ITC has low debt levels, making it financially resilient. The credit report explains how the company manages cash flow and debt obligations. Distribution network and supply chain. FMCG companies rely on strong distribution. ITC's products reach even remote villages, proving its logistics strength. How to use credit reports for better investing decisions. First, assess risk versus reward. Higher rated companies, AAA and AA, are low risk but may offer lower returns. Lower rated companies, BB and B, have higher risk but potential for higher gains. Example, ITC AAA is safe and stable. Varun Beverages AA plus, some risk but strong financials. A low rated company, BB, is high risk of default. Second, validate business models. If a company claims to be profitable but has a low credit rating, something is off. Example, if a new FMCG company claims to be as strong as ITC but has a triple B rating, you should investigate further. Number 3, use it when financial reports are unavailable. If you're analyzing a company without access to annual reports, earning calls, or internal data, a credit report alone can help you create a detailed equity research report. Credit ratings, investment grade versus junk. Triple B and above is investment grade, safe to invest in. Below triple B is junk, higher risk, possible default. Example, just like junk food is bad for your health, junk rated companies are bad for your portfolio unless you're comfortable with high risk, high reward strategy. Final task, start reading credit reports. Now that you understand the power of credit reports, your next step is to go through them and analyze companies for yourself. This will make you a smarter investor and a better equity researcher. Action steps, go to screener.com, find your favorite stock, and download its credit rating report. Read the business overview and understand why it has a certain credit rating. Compare different companies in the same industry. Use this data to make better investment decisions. Mastering credit reports will set you apart from average investors. The more you read, the sharper your analysis becomes.